Hey everyone and welcome back to another video for today. So the earnings season has officially started. Over the next couple of weeks, most of your favorite, if not all of your favorite companies are going to report their quarterly figures and hopefully give us some guidance for the upcoming quarter and maybe also for the second half of their fiscal year. So this in front of you is what's going to happen over the next couple of days. And in this video, we're going to talk about 4 companies where I do still think that it's worth taking that pre-earnings gamble, pre-earnings position. I'll explain why, but this is what's going to happen in the next couple of days. Of course, very popular and big names here in Verizon, Coca-Cola, SAP, Intuitive Surgical, Lockheed Martin here on Tuesday, and Face as well. And then on Wednesday, my favorite, we're of course going to cover that one. Alphabet, you have Tesla, IBM, ServiceNow, AT&T. Of course, Jose and myself are going to be live Monday through Thursday, and we're also going to do some earnings live stream. So make sure you tune in. And then on Thursday, we have Intel after hours. I own Intel, so that's going to be a big focus for me. But then if we look at the weeks after that, we of course have SoFi, PayPal, Spotify all on Tuesday, July 29th. Then we've got Meta, Microsoft, Robinhood, ARM Holdings, Lam Research, Carvana, Ford, all of that on Wednesday. That's going to be a crazy day here on the channel. Thursday, Apple, Reddit, Coinbase, Mercado Libre, CVS Health. Of course, I'm going to just focus on Mercado Libre since that's the only one that I own on that day. And then the week after that, we have, of course, the previously Advanced Money Destroyer, now Advanced Money Doubler, AMD, Arista Network, Snap, Clover. That's the name that suddenly popped up in my comment section. We've got Pfizer for those that are interested, Upstart. And then on Wednesday, AppLovin, Walt Disney, Duolingo, Uber. I love my Uber. And then we continue our way through, the first half of August. But of course, the earnings season doesn't stop there. I do wonder where Amazon is here on this calendar. Maybe they haven't confirmed the exact date. But in today's video, I want to touch on Duolingo, Nu Holdings, PayPal, and AppLovin. So if you enjoy this type of videos, of course, hit all the buttons. And we're already over 100,000 subscribers, so I don't even have to tell you what to do. But I do want to say thank you. Thank you very much for supporting me throughout this journey. I really, really appreciate that. I would also appreciate if you do check out the links down in the description and the pinned comment, or go to fool.com/couchinvestor to get the top 10 best stocks to buy now. And you can also check out all the other links out there. Some of them are free, so why not? All right, so first up, I want to start with PayPal. And for those of you that will tell me, why isn't Alphabet Google on this list? Because it's an obvious pick. Of course, I have to say Alphabet Google, but I already did a specific video about Google and the upcoming earnings report. If you missed that, that will be in the top right corner. But PayPal to me right now is, of course, again, one of those no-brainers. To me, maybe not to you, but to me, it's one of those no-brainers. It's one that did not really participate in the recent bull run. It's a company, a stock that is, of course, still having a 76% drawdown from its peak, right at the peak of the tech bubble in 2021, the pandemic bubble. And then even in the last 3 years, it's still down 27% from the recent highs. But if you look at the performance over the last 12 months, it is up 23%, has a market cap of $72.13 billion, trading P 16.6 times, forward one of 14.3 times, price to free cash flow, forward one 10.9 times. This is a company that, it's not expected to grow double digits, or at least not for now. Forward 2 years, revenue growth 4.3%, EPS expected to grow 10%. Now, you know why I like PayPal. I've explained it time and time again, but I'll try and make my case very quickly in this video. Now, more recently, they did have an event and they shared a little bit more information here. So Venmo, high double-digit growth with new accounts up 4% and average revenue per account is up 12%. TPV growth is over 100% offline and in Omni. Pay with Venmo is up 50%. Monthly active accounts are up 30%. They've seen pipelines up with new wins up 4 times when talking about new enterprises. Small businesses starts and restarts are up 2x. And then branded checkout modernization, they have over 45% of US volume now on the modern experiences. They do expect to grow, well, to have 80% of its branded experience on new integration by 2027. Now with PayPal, to me, the catalyst to push this stock back to, well, above $90, because we were at $90 at the start of the year, but I do still think that this thing can go above $100. The catalysts here are going to be Braintree growth. Right now it is being priced to value, so profitable growth and not growth at all cost. Well, for now we know that they expect growth to reaccelerate towards the back half of this year. They also told us that they're already ahead of schedule, so that's great. Seeing continued Venmo monetization, of course, talking about advertising business, it's still very small, but I'd like to hear a little bit more on that because I do think that that could be a billion-dollar business for the company, high margin business as well. Some omni-channel momentum, and then of course the margin dollar trend should continue on the upside. If we get all of that, I think the stock will go up. And in the meantime, they'll just continue to eat away at their own shares. This is coming down at a rapid pace. Right now, I believe if they do buy back $6 to $7 billion worth of shares at the current market cap, that's what, 8-9% of their market cap that they are just swallowing away. I mean, eventually the stock will have to move because it will just become a privately held company if they can continue to, well, eat up those shares each and every year. Plain and simple. Venmo has seen quite a lot of momentum, as I've shared previously. From a pricing perspective, this is still a very, 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 very cheap company that is still growing, but it's priced as if it is not. All metrics show that this company is growing. According to the Wall Street analysts, right, they are still expecting this company to grow top and bottom line and free cash flow as well. The more free cash flow that they can generate, the more shares that they can buy back. And no, I do not want them to pay me a dividend right now. Just buy back as many shares as possible. Margin-wise, gross profit margin, as you can see, we have seen some recovery there, with free cash flow margin about the same thing. We've had a big spike here because of a one-time thing in 2024. But again, things are trending in the right direction for PayPal. I mean, if we look at active accounts, right? Active accounts, all-time highs last quarter. So you cannot tell me that nobody uses PayPal. Clearly, more people use PayPal today than ever before, and active accounts growth continues to go up. Transaction margin continues to go up as well, and we've seen transaction margin dollar improving each and every quarter, especially since Alex Chriss came in. If Alex Chriss did not come in, I would not have been a PayPal shareholder. Plain and simple. And so to me, yes, going into this earnings report, I still think that buying shares before the earnings makes a lot of sense, right? Even on a technical here, we are above the moving averages. We are, as a company, doing much better today than before. We are not overvalued. We're not overbought. So risk reward here, definitely trending towards the rewards. Moving on to company number 2, and that's Duolingo. This one is a bit on the, let's say, riskier side, so I'd suggest starting pretty small if you want to build up a position in Duolingo. But still, Duolingo, as you can see over the past 5 years, this stock is up a tremendous amount, right? Beating the market, 165% growth over the last 5 years. Market cap just under $17 billion. Over the last 3 years, it's up even more. Then over the last 5, it's up 288%. Of course, it is currently experiencing a drawdown of around 31-32% from the recent highs. It is not as cheap as PayPal, right? I think we can all admit that, but it's definitely expected to grow faster than PayPal, right? Revenue for 2 years compounded, 30% growth, EPS 53.5%. But Duolingo is a damn good company that has very high margins and quite a lot of momentum as well. If we look at free cash flow growth, expected growth, right, from the analysts, it's expected to grow approximately above 30% for fiscal 25, 26, and 2027. So basically going from the last 12 months of around $300 million in free cash flow to more than doubling that in 2027. Earnings per share and net income expected to grow much faster than that, right? We go from the last 12 months, $2.02 in EPS to just over $6 in fiscal 27. Looking at net income over the last 12 months, $96.8 million. That's expected to grow to $316.6 million in 2027. So again, tremendous growth here, top and bottom line. Looking at the business, subscription revenue has exploded over the last couple of years. You've seen advertising revenue grow quite rapidly as well. The English test is growing, but not that quickly. It's coming from a very, very low base. Then in-app purchases, which is the purple bar right here, which has only been reported for the last 3 years, has grown quite a lot, but again, very, very small figures. Subscription revenue, that's basically where the money is at for Duolingo. Looking at some other metrics here, monthly active users, daily active users, then also paid subscribers. Yes, paid subscribers year-over-year growth rates are coming down, but it's still growing close to 40% year-over-year. If we look at the compounded annual growth rate for monthly active users and daily active users since the December quarter of 2019, has grown monthly active users 34.6% and daily active users 51.8%. So tremendous growth for Duolingo. And this is despite ChatGPT coming out at the end of 2022. So what? It had 2 years, right? 2 years to hurt this business. Currently, it does not hurt the business, right? The stock did overreact once, right? When the ChatGPT had that demo when they could auto-translate. But people go on Duolingo not to translate. People go on Duolingo to learn a new language and not to have the need to translate things. That's the big, big difference here. And Duolingo can do so much more in the future, teaching quite a lot of other things as well. Now, if we look at what the analysts are expecting Duolingo to report in the upcoming quarter, $240.9 million in revenue, EPS coming in at around 58 cents, and free cash flow to be at, well, just under $70 million for the quarter. Looking at the stock right now, as you can see, the drawdown of around 32%, the stock does sit just on top of that 200-day moving average. So yes, it did go under, this is by the way on the weekly, it did go under, but it did manage to recover and finish the week above the 200-day moving average. As you can see previously, it did spend a couple of weeks, well, up and down, but then rebounded. So let's see if this happens here yet again. This one is not one that has been overbought, right? Especially not right now. So RSI is quite neutral. Going to this earnings report, I do think that they'll again report quite a good quarter. With this one, technically speaking here, I think it's a very good position. Now, of course, until the next earnings report, which is expected to be in around 2 weeks from right now, a lot can change, but business-wise, I do like it. But in this case, start a bit smaller than a PayPal, for example. Moving on to stock number 3, and that's AppLovin, a stock that, just like Robinhood, could have been added to the S&P 500 already, but did not. Now, AppLovin, as you can see, over the last 3 years, the stock is basically up 10x, well, around 10x from its lowest point for sure. Year to date, stock has been performing at the start of the year quite well, was up close to 50%, then was down 30%, and we're now only up around 6% or so. It's also experiencing a drawdown of around 28%. Has a market cap of $123 billion. And if we look at the pricing metrics, trailing PE 65.8 times, forward one 39.8 times. Price earnings to growth ratio 0.8. Margin wise, very, very good. Gross, operating EBITDA, net, free cash flow margin, all very, very good for this company. And if we look at the expected growth rates, revenue basically growing compounded close to 20% for the next 2 years. EPS growing closer to 59% compounded for the next 2 years as well. Looking at what Wall Street is expecting this company to report, revenue around $1.38 billion, which is a bit higher than what the company itself thinks it will report. EPS $1.96, and then free cash flow for the quarter coming in at around $771 million. Looking at expected growth for free cash flow in the upcoming fiscal years, for fiscal 25 growing more than 60% year over year, then 29.6% in fiscal 26, and then another 28.2% in fiscal 2027. How do they generate revenue? Well, the majority of their revenue is generated through software platform revenue, which is the yellow bars right here. then in-app purchases, which have been decreasing over the last couple of years, and then in-app advertising revenue, same thing, that has been coming down over the last couple of years. And you can see what they've reported last quarter. Advertising revenue was up 71%, app revenue down 14%, but total revenue was still up 40% year over year. Advertising adjusted EBITDA up 92% year over year, and net income up 144% year over year. Looking at guidance, total advertising revenue, midpoint $1.2 billion. And then you can add, yes, maybe a little bit from the apps revenue as well. And you come a bit closer to what Wall Street is expecting. And total advertising adjusted EBITDA margin, 81%. Now, last quarter, they also told us that the company believes this guidance positions it to continue driving strong growth and value for partners and shareholders. They continue to believe that 20 to 30% is the right long-term growth rate for the company. And so right now for AppLovin, here, of course, we have seen a nice rebound from the April lows, which here as well, you can see that the stock went under the 200-day moving average. And now we're sitting right above the 20-day one. Of course, still lower than the peak right here at around $515. Again, this is, in my opinion, a very strong company. The first time I heard about this company was when we heard that AppLovin wanted maybe to acquire Unity a long time ago. Well, since then, this company has done tremendously well. There was also, I think, a bearish short seller report that came out that crashed the stock. But I mean, they continue to perform well time and time again. And so that's why the stock has been crushing it over the last couple of years. And here as well, I think before the earnings report, you can already start to accumulate a little bit. Moving on to the last one, and that's New Holdings. So New was down around 7% on Friday. You asked me why. I said I don't know, and I still don't know. I haven't found anything. And if it's about the tariffs on Brazil, Brazil exports not that much, and New is not an exporter since New is a digital financial platform, a neobank. So again, could be here another overreaction. Over the past 5 years or so, stock is up 30%. Over the last 3 years, stock is up 225%. And year to date, the stock is also up around 31% and experiencing a very, very small drawdown of around 7% at the moment. Has a market cap of $62 billion, trading PE 31.8 times, forward PE of 24.5 times, and a price earnings to growth ratio of just 1. Revenue compounded for the next 2 years, 26.4 times, EPS growing faster than that at 33.7 times. This is a very, very good company that I don't own because, can't own them all. I own Mercado Libre, so I already have that exposure to Latin America through Mercado Pago, their fintech arm. But New is a high quality business. As I've shown you time and time again, it's a very, very good business, best in class with very, very good management. Customers have increased by 19.3 million year over year. Active customers sits at 98.7 million. That was up 16.1 million year over year. Revenue at $3.2 billion, up 40% on an FX neutral basis year over year. It's a very good company that, despite thinking that it might be mature already in their biggest market, which is Brazil, as you can clearly see right here, still gross profit market share rise, very, very small compared to the big opportunity. Same with the other market, Mexico here, very, very small squares. I expect them to become bigger and bigger over time. On all metrics, this company is doing very, very well. Even if you think that, high interest rates in Brazil, although I did speak with people there and they said they expect this to be the peak already. So that could be helping companies like New Holdings. Everything happening inside the company, right? That things that they can control, it's trending in the right direction, right? Even when there were talks about, look at their NPLs, for example, those things are not doing well, margins are not doing well, etc., etc. All of those things management have already explained a couple of quarters before these things happen, right? They are investing in the company. This is by design, right? Even when this happened, the NPLs, 15 to 90 NPLs here, yes, still trending in the right direction, still according to plan. And they explained why this has happened, right? Why we've seen a rise here in 90 days plus NPLs. They've explained it, and look at what has happened. Boom, coming down right now. So it's very important to know what you own, and it's very important to have confidence in management. Because of course, I can find you other companies that have tried to explain things, but then the exact opposite happens. And that's how you, the investor, lose trust in management. And that's definitely how Wall Street loses trust in management. And that would mean that the management and the company will not be getting a premium from the market. Looking at the stock right now, as you can see, it sits at $13, which is exactly where the 20-day moving average is at. RSI is pretty neutral. The stock did spend sometimes just on top of that 200-day moving average. Then we saw a nice little rebound right here with Nu. If I would love to add a new fintech company in my portfolio, Nu and Shift4 would probably be the two companies that I would be looking at. Why is that? Simple. Good management, good product, good company, very, very easy. So same thing here, going to earnings report. If you like this company, why not just open a small position? Then you get to hear what management has to say. Stock goes up, great, your position goes up. You had more information, you can accumulate more. Stock goes down, company explains what has happened during the quarter. If you think that the quarter was good, then it might be an overreaction and you get to buy even more shares of a good company, plain and simple. And so all in all, that's about it for me in this video. Yes, of course, dLocal, although I don't know when they report earnings exactly, that's why they're not in the video, but dLocal at current prices to me as well is one of those no-brainers risk reward wise. So let me know what you think. What companies are you willing to open a position or add before they report earnings? Let me know down in the comment section below, and I'll see you all in the next one. Bye bye.